Marcus is 38. He works full-time at a warehouse in Memphis. He makes $28,000 a year. 8 months ago, his car broke down on the way to work. The repair was $300. He didn't have it. His next paycheck was 11 days away. He found a payday lender. He borrowed $300. 8 months later, he has paid $840 in fees. He still owes the $300. This is not a story about bad decisions. Here is how the math works. You borrow $300. The fee is $15 per $100. That's $45. You pay it back in 14 days. Seems manageable. But annualized, that $45 fee on a $300 14-day loan is a 391% annual interest rate. In some states, Idaho, Utah, Texas, the average APR exceeds 600%. The fee is not the trap. The trap is what happens on day 14. 80% of payday loans are rolled over or reborrowed within 2 weeks. The borrower cannot repay, so they pay the fee and borrow again. Same $300. New $45 fee. 2 more weeks. Marcus rolled his loan 7 times before the cycle broke. Each rollover, $45. 7 rollovers, $315 in fees. Still owed $300. He eventually borrowed again to cover a missed bill. That's when the second loan started. Here's what the industry knows. 75% of all payday loan revenue comes from borrowers who take 10 or more loans per year. Not first-time borrowers in a crisis. Repeat borrowers trapped in the cycle. The product is not designed to help you through an emergency. It is designed to make your emergency permanent. And who are these borrowers? 81% are employed full-time. The average borrower earns around $30,000 a year. The median borrower takes 8 loans per year. This is not a product for the unemployed. It is a product for the working poor. People with income, but no buffer. People who cannot afford one bad week. The industry calls this serving the underbanked. The business model calls this a revenue stream that only works if you cannot get out. In 2010, Congress created the Consumer Financial Protection Bureau, the CFPB. It was a direct response to the 2008 financial crisis. The stated goal: protect ordinary borrowers from predatory financial products. In 2017, after years of research, the CFPB issued a payday lending rule. The core requirement was simple. Before issuing a loan, verify that the borrower can actually repay it. The ability to repay standard. The same standard that applies to mortgages. The payday lending industry spent millions in lobbying fees fighting it. In 2018, a new CFPB director was appointed. He had previously called the CFPB a sick joke. He moved to delay implementation. In 2019, the mandatory underwriting provisions were gutted entirely. The rule that was supposed to protect borrowers was stripped of its core mechanism. In March 2025, a revised version of the rule finally took effect, 7 years after it was written. Within days, the CFPB announced it would not prioritize enforcement. The protection existed on paper for 7 years before it could help anyone. Then it was announced, and immediately deprioritized. Here is what you can do. If you are facing a short-term cash gap, look for a Payday Alternative Loan through a federally insured credit union. These are federally regulated. Maximum $1,000. Maximum 28% APR. Same access. Different rules. 18 states and Washington, D.C. have banned triple-digit APR payday loans outright. The states that haven't are not unaware. They have simply chosen not to act. Marcus eventually found a credit union Payday Alternative Loan. He borrowed $300 at 28% APR, paid it off in 3 months. Total fees, $11. Same person, same income, same emergency, different product. The difference was $829. That difference is not luck. It is not discipline. It is access. And access is a design choice made by people who are not in the room when you need $300 on a Tuesday. That is not the market protecting you. That is the market pricing you. And if the price is 391%, you were never the customer. You were the product.